We want to try to get as much of a research advantage as possible. We try to be as independent as we can. Our research is primary research where we conduct the research ourselves.
Similar was half and half, like half.
When I'm looking at a company, the first thing I want to do is try to understand the history of the company. I want to understand where they come from, where they are today, as we think of like threats, opportunities, more of a qualitative perspective. I also want to understand their competitive positioning. To me, market share is one of the biggest drivers of how a company is doing in the marketplace. Are they gaining share? Are they losing share?
What are the strengths of the suppliers? What are the strengths of the customers versus that business's ability to survive in the competitive rivalry in its industry? We want to understand everything about that before we put our clients' money to work.
The way I think about fundamental research is there are basically two pieces to it. One is identifying good businesses and the quality of the business. And the way we do that is through speaking with industry contacts, oftentimes through expert networks. And then what we're looking for is, does the business have a competitive advantage?
When you really dig into the details of a company and you figure out the unit economics, you're looking on a plant-by-plant basis on what it costs them to make widget X and how that compares to their peers and what are the advantages from a transportation standpoint and those sorts of details that I think really helps parse out a good business versus a great business and what might be a good investment versus a poor one.
When we think about business quality, what we're ultimately looking for is a company that's leverage point or its debt to earnings is substantially lower than what we believe the business valuation is. And the types of things that can create that difference are strengths of the business, such as recurring revenues, high margins, low cost structure, that cause the market to value that business higher than other businesses. So we find high multiple businesses typically have higher leverage points, and the market doesn't appreciate the equity cushion above that leverage.
One aspect of companies that might be overlooked by the market is the quality of the management team. That's a very important aspect. Looking at their track record, looking where they've been, how they've performed with bondholders. Are they equity friendly? Are they bond friendly? Or debt holder friendly?
The second piece of doing fundamental research to me is doing what I call hanging the number on a company or figuring out what the enterprise value is. And for a credit investor, the reason it's important to know the enterprise value of the company is we're comparing what the enterprise value of the company is relative to how much debt's on it. Brian's made me a better investor by pushing me to do deeper fundamental research than I thought was ever possible.
We spend a lot of time understanding the options that a company has in order to adjust its capital structure based on market conditions and the current pricing and outlook of the business.
Providing G&A services, basically.
Prior firms, you could be asked to cover anywhere between 50 plus different companies. That becomes very stressful, and it's hard to actually do the fundamental credit research that's needed.
And having a 20 name cap per analyst on owned names gives us a distinctive advantage and ability to really go deep and also look for new opportunities on the research side.
To me, a quality business is one that has a sustainable competitive advantage. You know, something it's just the classic idea of having a moat around the business. I think what the moat does is it lends longevity to a business model. If you're investing in or looking at a quality business, I think there's going to be a narrower range of outcomes over time. That range of outcomes is going to be skewed to the positive because it's a business that can grow revenue, it can grow profits, and it's going to be able to deleverage the balance sheet faster.
And when we're making projections, we tend to be very conservative. We try to make sure that we're factoring in any potential downside to the business that could potentially result in impairment. Credit investing is very unique relative to equity investing. With a lot of our companies being private equity owned, the incentive to promote the company or the stock is very low. So we spend a lot of time really digging into the competitive environment, the strategy of the company, and the outlook of the business. It allows us to ask better questions of management and have greater understanding of the risks and the challenges of the business.